Startup Incubation and Innovation Center, IIT Kanpur. This webinar is brought to you by the C3I Hub, IIT Kanpur, the Technology Translation Research Park by DSC at IIT Kanpur, which has supported more than 50 startups in cybersecurity domain. The topic of the webinar is your startup investor ready? Legal, finance, and compliance essential? Today we have with us an industry expert, CS Sheetal GK. She is the founder of Elstad Business School and a broad member in multiple organizations guiding entrepreneurs on investing readiness and scaling strategies. She is also a startup advisor, business strategist, and qualified company secretary with over 10 years of experience in startup structuring, fundraising, and compliance. I would like to welcome her to share her insights on how startup can be investor ready and avoid common pitfalls. Just want to give you a small suggestion to all the startup founders and innovators to be interactive. And if you have any question, please drop them in the comment box. We will address as many as possible. Now over to you, ma'am.
Thank you. Thank you for the nice introduction. Hi. So I'll just share my screen. Oh, my screen visible?
Yeah, it is.
Yeah. So my topic for today is be covering is a startup investor ready. So we'll be covering the topic like legal, financials, and compliance essentials. So I'm Sheetal. I'm a practicing company secretary and a startup consultant, founder of Elstad Business Solutions. I help the founders right from idea to IPO stage, helping them in financial, investor readiness, and also preparing for the IPO. So yeah, let's start. So to begin with, why investor ready is crucial. So investors, like when they are funding, they see, of course, the product, your team, and all that. But another crucial thing is they also look into your structure. If your funding structure is right, whether it's legally compliant, whether all the compliances are properly done. So this is one of the crucial things which all the investors they look into it. So before, like once your pitching is done, next after the pitching, there'll be a data room where the due diligence happen. So they check into each and every angle. They check all your legal documents are proper, whether the compliances are done regularly, there is any problem or any issues happen, there is any non-compliance made. So if everything is okay, only then they move further. So if you're not ready, what happens? It gets in the delayed, funding gets delayed, the valuations may be lower, and you may also lose your credibility. There are many instances, many founders have come at the last minute saying that the investor is ready, they wanted to invest now, but because of there is the compliances which they have not done, so that delay have caused, and many investors have even backed out. So it's always important that at the early stage itself, you should always clean up all your legally or the financial, everything is proper. It should be maintained that the records it and have check once again before the data room, before you pitch itself, that everything is maintained clearly, so that it is not only costly but it also gives that in confidence for the investors that you are maintaining all your records and it is ready. It is not like just a hustle or something which is that you are not doing it. It is literally important for the investors to know that you are maintaining it in a governance in a proper way. So this also gives a clarity for the founders that of course running when your business and all, not taking care of the legal things, you may think at times what happens when this investor things happens or this thing. So in that case, it's always early to start at the beginning itself. All your data is to maintain properly. So what do investors, they look beyond the products? Of course, the product is important. At the same time, they look whether you have a strong governance and the legal structure is maintained. They look at a scalable business. If any hustles or anything comes in between, it will not be scalable, right? So they look if it's a scalability is there, financial discipline, which is very, very important. If you're being a professional, we should know how to handle the financials. Even a small, minute financials in and out of the cash flows have to be maintained properly. So financial discipline is very important, which they look into it. Another thing is the founders' alignment and commitment. So founders at the base itself, if there is any disputes among them, if the founders' alignment, if the agreement is there and the founders are properly aligned and their roles and responsibilities are clear, if the equity is maintained properly, if all that there's no dispute among them. This is also one of the clear things which investors do look into. So now let's look into what are the legal essential documents. So if you're an aspiring entrepreneur, you wanted to start a business, always first you have to see the company structure. There's sole proprietorship, partnerships, LLP, private limited. But if you want to go as a startup and registered entity, get into DPIIT certifications, and of course the investor point of view, they always prefer private limited company because there, it's very easy. It's a structure where the equity shares can be maintained if any transfer happens. So always go for a private limited registered company. If you are already a private limited registered company, the another legal thing which you have to take care is the MOA and AOA. At the beginning of the company, once you register itself, you will get these two documents, Memorandum of Association and Articles of Association. In Memorandum of Association, where it will be a name of the company, which you can amend it later, or the objects of the company, your registered office, what is your capital structure, everything will be all the records outside, it will be there maintained in the MOA, which you have to be very like seriously taken care, because sometimes I recently got into a case where a founder who registered a company stating for an objective of manufacturing a spare parts, but then later stage he got into a different business, but he didn't amend the MOA and ROC got the compliance. So whenever you are wanted to change a business or whenever you want to look into a different structure, always amend your MOA for the different object clause and then do it. AOA, which states the internal, what's your rules and regulations of the company, whether it be your what is your roles, what is your responsibility, board structure, your share transfer, your voting rights, everything contains in the articles. So based on the articles only, the companies, all the procedures work. In case if you're bringing in a shareholders, then after the shareholders agreement, whatever the shareholders new rights and everything, that has to be amended with the AOA, then it becomes a new AOA of the company. Another important thing which most of the founders don't do at the early stage is the founders agreement. Founders agreement is very important. Maybe you might start your business with your friends or colleagues, but the later stages some disputes or happens, and then at that time they it may ended up even at the closure of the company. So always in the beginning have an agreement with your founders stating what is the roles and responsibility each founder is carrying out, what is the equity, what is the split they have, and exit times, what will they will do. So everything has to be maintained properly in the founders agreement. Then it's a IP ownership. So if it's a company, the IP, whether it's a trademark or a patent or a copyright, whether if the IP is there and who's having the IP ownership. Sometimes the founder will hold it, or if the employee is also involved in it. In that case, it's better always have the IP transferred to the company and let the company have the sole IP ownership. Then now it's an NDA, non-disclosure agreements. Most of the founders don't neglect this thing, but this is very, very important. Always have an NDA signed, whether it is with your employees or if any freelancers or your interns or partners, vendors, whoever it is. If you have any confidential information or if you have any IP or any patent or anything else, whether it be your designs, whether it be your coding, your data source, whatever it is, or database, have an NDA signed mentioning all the clients of the confidential information, and then move for the further like whatever you're getting into the agreement or whatever is the closure, always have this NDA signed. In an NDA, if it's IP assignment clauses is there, always try to keep it even at the offer letter or having with the employees before the employee, if you get taken employees of offer letters, have this IP assignment clause signed. Where it is most of the cases, some when you are developing the product, sometimes freelancers or your employees or somebody, they will be also involved in the product. So it's to protect that at the early stage itself that this is a something which the company is owning. It is not the employee is not a part of it. So the IP rights should go complete. So owner of the IP right should be the company. So for that, IP assignment clause is very, very important. Next is the ESOP. It's its employee stock option plan. So any early stage companies, when you're going, it's very difficult at the pay at the early upfront cash, right? So at that time you can have this ESOP, which is for the employees. You can give the ownership, your equity ownership. This helps to attract new talents, or if you want to retain any employees, or for giving them the motivation that they are also a part of the company. They are also like a, some of the ownership also it gives with them. So for that you can have this ESOP. For this ESOP pool, you can have it at the initially itself set it up either it is 10% or 15%, whatever, as per the ESOP scheme, which have an agreement ready. And in that, you set up the ESOP pool. and with your board and the directors and shareholders have the approval ready and the documentation properly filed it and have this ESOP pool ready. So in case if you're going for the investor, tell them clearly that the ESOP is maintained and ESOP is already we have a set of pool which is allocated for the employees. So now some of the compliance checklists which you have to follow if it's in a private limited company, if you're following it up. MC, it's annual filing. So always the annual filing, there the two forms, ASC 4 and GT7, along with your annual report. So where you'll have the director's report, the annual report, your auditor's report. So companies complete everything, all the maintenance of the financials and everything will be there, and we will be filing with this with the government. ROC will be filing it. So there are many cases, most of the founders, they ignore this and end up paying a huge penalty. So if you ignore it like 1 or 2 years, even if it continues for 2, 3 years, that can even lead to the strike off of the company. So always be careful that you do the annual compliances at the proper time, paying the proper regular fees. Next is the GST. If you're a GST, even that when time whenever the GST timing, to pay the proper GST. Otherwise, you may end up in a GST penalties also. Then TDS, or if you are applicable with PF or ESI, in that case, if the 20 plus employees in the tech companies or if the power companies 10 plus employees are there, have regular PF or ESI setup and then do the proper compliance for that. KYC update for all the directors, KYC update in a yearly, that has to be mandatory done. In case of any deposits, any loans or anything, DPT3 has to be filed. FEMA compliance. It's a Foreign Exchange Management Act. If any, this is with the RBI along with this ROC, the government filings. We'll have to go for the FEMA compliances in case if you have any foreign investor or if you're transferring in share to the foreign investors or allotting the shares. On that case, always the FEMA will be applied along with the ROC. This has to be done at the proper time with the time limit. Otherwise, again, this may end up with a huge penalty. ROC update. So once a company you have incorporated and you have started it, always maintain board minutes and annuals. So in a year, at least 4 times the directors has to meet. They have to discuss about what is happening in the business. They can discuss about the business proposals or what is happening in the 3 months, any new directors change or anything. So when any director change, internal, anything is happening, new shares, if you're transferring or if you're bringing in new director or removal of the new directors, always you have to update with the ROC and we have to file the forms. This you all have to keep it in mind. Then in case of registered office, if you're shifting the register office, like maybe at the initial time, you would have kept some register office. Later on, you have shifted the register office. That has to be intimated to ROC and we have to change the address from the previous address to the current address. Now, along with the compliances, financial hygiene this is one of the most important thing which all the founders has to take care. And always the investors they look into the financials because that is most important, right, for the business. So if the financial proper accounts are maintained, whether the bookkeeping is done clearly, that initially, even if it is an Excel in the initial stage, it's fine, but it's always better to go for a like electronic software. Even for any private limited company, electronically we can maintain it. Tally or Soho Books, have your records properly maintained. Whatever it's a clean bookkeeping, up to date accounts, how whatever it any day to day activities, maintain it clearly. All the invoices and everything, even the bank statements, and try to maintain all your bank your transactions through the company account. Keep it separate, your personal account separate and your company separate. Don't do anything even from the director's thing. Always have it maintained from your company accounts and reconcile it bank statement. So this either the auditors or even if you're going for investment, so investors for the time of due diligence, they reconcile your bank statements, whether it is all financials are maintained, all the transactions are entered properly, or whether it is matching with the bank statement. And invoices. So all your invoices, how much you wanted to get it from or how much you are about to pay, all the invoices has to be properly maintained. And also do the GST filings properly so that you don't miss any input or tax credit. Payrolls. So payrolls for the company, it is very, very important. Maintain a proper payroll, document it, and along from the offer letter to the whatever the payroll, everything, pay slips, maintain the payroll completely and properly recordically. Clean profit and loss balance sheet and cash flows. So all this at the end of the year we'll be maintaining it, but quarterly, all the like whenever you are board meetings or anything happen, have a quarterly report where you check your profit and loss. What is your income? What is your expenses? How it is maintained? Whether how much revenue are you getting it? There is any profit you're making or you're in the break even. Try to have a profit and loss statement quarterly basis done, and see your assets and liabilities, how it is standing, whether there is any loan, how when is the repayment back, or you have taken any debentures which is any converted. Always check this at least in a quarterly base. Check your profit and loss and balance sheet, and then if anything is there, talk to your auditor and get it done at the initial stage. Don't wait for the end. So now let's see the instruments used to raise the funds. So now if you're going for an investment, how you can raise like the fund through, what are the sources? Of course, first is the equity share. So equity is a standard ownership, like when your company incorporated, there with along with the voting rights, we'll have a standard ownership, that is the equity shares. Now, if it is CCPS, that is along with the other thing is the preference shares. Preference shares, they will not have completely like equity, it's a differential rights. So if it is a preference shares, in the CCPSS, which is a compulsorily convertible preference shares, at the later stage, it can be converted into equity, which is compulsorily, not option, compulsory, it will get converted into equity. So there will be some predetermined time. At that time, based on the agreement, it can be converted. So we can bring in an investor with the CCPS round. So in that case, what is the benefit is that for the investors also, they don't have at the early stage itself, they don't want to get into equity. If any closure of the company happens, or if they are going for any winding up procedures or liquidation, they get the early preference. Even the dividend also, if they want, they are claimable more than the equity shareholders. And for the founders, it's easy because for them at the early stage, they don't need to dilute their equity. So till then, still the CCPS, whether it's 2 years or 3 years timeline is there, they can still keep it as preference shares, and until after that only they have to dilute the equity. In the same way, like preference shares, another option is CCD, which is compulsory convertible debenture. So where that is a shares, here it is like a debentures, it's like a debt. It is kind of a loan or borrowings, you can say, where there'll be interest rate. But it is not mandatory to have that interest rate at the beginning. Even with zero interest rate, CCDs can be raised. So this debt instrument where it equity at a predetermined rate, it can be converted. So in 2 years down the line or 3 years down the line, or where's the next round or pre-series or A, series A if you go, so that time it get converted into equity. The same way with an agreement we can go, but for both CCD and CCPS, the valuation is mandatory. And this is a case where again the equity is, they don't have to dilute the equity for the founders at the early stage. They can maintain it as under, this will come under the long-term borrowing, so debt will be there. Then later point of view, it can convert into equity. Convertible notes. So convertible notes are like a short-term debt. The here it is mandatory, which should be a registered like startup DPIIT recognized company of startups. Only for that, this convertible notes can be issued. Minimum check size of this is 25 lakhs, 25 lakhs of or above, and it should be in a single transaction. They cannot close it. So single transaction, this has to be there. That is a mandatory requirement for convertible notes. So through that also you can raise your funds. So, when you're going for a fundraising, what are the legal documents which you have to take care? So, one is a term sheet. Term sheet is something non-binding document where it gives all your investment amount, whether it is your valuation or it is your securities or how it is your shares or everything. It will be maintained, like it will be outlining in the term sheet, and then this will be signed with the investor. Once the term sheet is done and the investor is ready and then he's ready to purchase the shares, in that case, we will go for the SSA, that is share subscription agreement. Even there, everything will be mentioned, that how, what is the rate we are giving, what is the valuation currently, how many shares they're going to get it, all that. And another thing is the share holders agreement, that is SHA. SHA is where it is that it defines their rights and obligation, what rights they have, what is the thing, and this gets amended to the Articles of Association with the AOA, and that from there only even they can participate in the board meeting, they get the right, even they have to be included. So it depends upon how we are in the terms close, the deal closed it like that. We have to have this SHA get amended with the AOA. Another thing is NDAs and MOUs and strategic partners. So, in the data room, of course, these things are also important. They're protecting the confidential information, that if any IPs or anything is there, that it doesn't get from outside world, that it is not loose or there's no leakage in the whatever the confidential information you have. So always it's better to maintain any NDA signed with your your MOUs with the strategic partners. So investors in the due diligence thing, they also look into these documents. Then proper board resolutions and other things. So any for any compliances matter, whether the properly board resolutions maintained, or if you're authorized any fund previously, you have raised any funds, whether for that all the compliances have done properly, whether the ROC filings are there, any board resolutions or any other resolutions which you have already passed, whether that's all recordically kept properly, so that the companies officially the company is approved, all that that will also be taken care. Next is the cap table clarity. So cap table clarity is very, very important. So investors, this is one of the most important thing which investors look into it. What is the cap table currently looks like? So the equity, whether if the founders it's given at the proper, if there is any angel investors previously they have raised, in what valuation they have raised, and what is the terms, and currently what they will be getting it. So for that, if we are getting it any incubators or an accelerator, whether there is anything kept there, so that also will be checked. And in ESOP, whether ESOP is always done before the investment, whether it's 10% or 15%, if it is allocated, and for that proper board record is the board meeting is there, and board they have resolution is passed, all the approvals is kept properly. So the investors look into the cap table. Some founders we've seen, like, they promises that even maybe to the within among themselves, that they will give the equity, but the recordically it won't be maintained. So in that case the cap table clarity won't be there, and investors get confused, and they will not be in later stage it will not, because it will be more dilutions will be happening. So always have that cap table clarity and do the cap table before investment itself. Have a cap table ready with you, stating all your current what is the thing, if you have any diluted shares, or if you have raised any CCDs or any CCPs, everything is kept properly documented. So some of the documents which you need to be preparing before the fundraising, which is mandatory, of course, beyond the pitch deck. So this, like, once you're pitching to an investor is ready that, okay, now this is like, okay, I'm interested in your pitch, I'm interested in your product, I'm ready to invest. So that is the time which they will come into the next picture. So there they will be the data room or due diligence process happen, where they check into each and every document. So what is your clarity which you speak in that pitch? The same clarity you should have for the legal and compliance angle as well. So check all your legal, right, from the company incorporation certificate or to your memorandum, your articles, if there is any amendment which is done, or if your board resolutions or any agreements, whichever the agreements which I spoke, if all those are in the proper. So have in a data room, have in a folder, kept everything ready, so that at the before the you're investing, or if before the investors are ready to invest, have this ready with you. The financials, which is very important, have your 2 to 3 years of financials. If your company is incorporated in maybe 2 years or 3 years, keep all the financials, proper audited financials ready with you. And also have the projections. If you have any projections which you have already set to the investors, have the financial projections ready, because they look into the financial projection as well as your previous audited financials. Then any tax filings, whether those everything is done, so they also check those documents. Compliances, like I said, all the MCA compliances, like the ROCs, right? The yearly compliances, or the any other compliances with any director's approval or transaction compliances, and the GST, if it's filed properly, also check. So all at the time of due diligence, compliances also is one of the important thing which they check into it. And as a IP, if any IP, if any trademark, or if you have patented or anything, check, see that it is into the company's name, not to any individual founders or employees or freelancers. So make sure that IP is there, and if you have the IP, if it is already transferred to the company and all the documents are properly ready. The HR. So for HR point of view, we have to see if the ESOP policy, the agreement or scheme of arrangement is ready, the offer letters are properly maintained, have the NDA signed with all the employees, and everything is properly. There is no queries with the HR. traction. If at all you have said anything at the time of pitching, that your sales report or any metrics which you have used or any kind of dashboards or anything you have given the commitments, have that recordically, because that is also whatever commitments you give recordically, it is important and they will check into it. So some of the red flags, like the investors, they check this. Of course, they see if any missing filings is done or any outdated records, MCF is not maintained, any proper records is maintained. They see if the cap table, any descriptions is there, whether the cap table is properly maintained or not. If that is not there, then of course cap table is very important, which they check into. GST mismatch, because if GST, if there is any mismatch or anything, huge penalty and huge things will come. So GST mismatch is another thing which you have to take care very seriously. Then any tax in notices or any other non-compliances which has happened previously in the company, if that is there, that will also lead to a kind of a red mark for the company that it is not doing the compliances properly. Founder's IP, if the founder, the initial stage would have maybe, kept the IP rights with them, but wouldn't have transferred to the company. So that is also one of the important thing, that they check that all the IP rights are with the holding by the company, and company is a sole owner for it. No other founders or other persons are involved in the IP. So some of the common mistakes which the FP founders, they do normally do is they ignore the compliances, because of course the early stage it's like or even if it is at the stable side or the company, they mostly check into the products and keep this, that this compliances is not imported at the early stage, but later they may end up either paying huge penalty, or at the time of investment they may not be ready. And of course we know how the investors, like, they, if you are ready to close the deal, then at that time you have to close the deal. If there is any delay, we don't know, they might even back out. So always have, ignoring this compliance might, it may not show a good sign. So have the compliances part ready at the early stage itself, and mixing their personal and business finance together. So they might be using for any travels or anything related to the company also, they might be using it from the company accounts, and the finance, maybe for the company purpose they'll be using from their personal account. So all that mixing finances will not, that is not, we cannot audit it. So better have a separate finances, even if it's a founders or whatever it is, have it from the company accounts. Don't mix your personal and business finances. Then verbally equate promise. So verbally, maybe promising anything to employees but not getting it, or maybe bringing another co-founder of you, promising that you will give this equity, but it is not properly maintained in the books. Or if you have maybe, done your companies or any technical things with some of the other agencies or something, and promising them that you will give the equity, but that is not in the account. So all these later, might get into any disputes. So always don't give any verbal equity. Whenever you're promising an equity, have it properly done, and compliances has to be properly taken care. And not documenting any founders. This is very important. In the beginning itself, I said, like, founders' roles and the exit terms has to be properly done, because initially when you're doing it, we not know, but later stage anything can happen. So always have the roles and responsibilities of the founder along with the equity and the exit terms done. Maybe an agreement like this, sign it and keep it. So to closing of the some of the things which you have to take care is, have an internal due diligence checklist. So you always make sure that you are going to pitch to an investor, it will end up into a due diligence. So have an internal due diligence where, you see if there is any gaps or anything is there, any documents has to be properly maintained or any documents has to be done. So have it ready at the initial stage itself and run your internal due diligence, and organize a virtual data room where all the whatever it is essential documents, keep it in a separate place, so that it can be at any time if the investor asks, you're ready for it and you can show to them. Reach out if they are not able to do it. Ask any compliance or who are auditor or whoever it is, and in compliance support to anybody. Ask it and keep it in a professional way. Take it a help and do it in a professional way. In the early stage, always try to do it so that you don't have to stress later and you can focus on your business. So and you don't have to worry about, okay, what happens, because raising the fund itself is a big headache which all the founders which go through. So after that, going through all the due diligence process, and if that is not there and somehow the investor comes and they back out only because of this, then that will not be a good sign, right? So always, to avoid the stress, initial stage itself, have all the documents done properly. If not, ask help and then do it. Yeah, so that's it. So thank you.
Okay, so now we will move to the QA session. Okay, we have first. Okay, so I have received few questions on my WhatsApp. Okay, the
Okay.
first one is, what advice do you have for women entrepreneur in navigating fundraising and compliance challenges?
Advice to the women entrepreneurs, it is like there are a lot of now options is there for the women founders, like a lot of fundraising incubators are also there, even the governments here also in where in Kerala or anywhere else she take, and a lot of things are happening for the women founders, so they can keep applying. And even the governments have kept a reservation for the women founders itself, where if in a group, if there is a women founder as a part of it, they can fundraise very easily. It is available there. And challenges, of course, like it depends on what area you look in the challenges. In the compliances point of view, there won't be any challenges because it's equal for if it's a man or woman. But other than that, if you're looking for any other kind of fundraising, if you really wanted to go raise the funds, there are a lot of options. As I said, not only in India, even internationally, there are a lot of options which is reserved for the women, so you can always avail for that.
Okay, the next question is, what compliance gap can kill an investor deal even if the product is strong?
Compliance gap can kill means, like I said, like if the equity is not maintained properly, they would have maybe promised an equity, but an ESOP pool of it have given, but that is not recordically done. Or the CCDs or CCPs, there are a lot of times they have raised many of the founders have raised it, but that is not shown. Or ESOP, it is like given to the ESOP, but initially the ESOPs is not shown in the cap table, so that end up the investors equities also, they will get diluted, right? So always these kind of the things has to be taken care, whether the ESOP is properly done, or if any equity in the early stages of any dilutions or anything is happening, whether it's CCPs, which is later conversion, all post compliance things, right? Post funding, that has to be properly maintained for the recordical. So otherwise, these, if the cap tables are not the proper equity and this thing is not maintained in the company, that end up that investor will not have a clarity like what is the dilution process is going to look like.
Okay.
Yeah. Thank you. Sheetal, we have also a few questions from the webinar here on the Q&A panel. So Ronit has asked कि for a founder who has not made a company yet and is trying to pitch an idea to an investor, what are a few legal structures that they can follow to get an investment from at an ideation stage?
Okay, so there are a few investors who look into the idea stage,
Yeah.
but then again, they like along with how the team is the most important team and your product, that is very important. But they also look into the credibility, right? So if you're not formed as a proper organization and all that is there, then the liability will not be there, and they don't know how to go for it, the transfer or the shares, how to get the equity. So it's better at the idea stage, you can try maybe applying to any accelerator programs or applying to any kind of incubation centers and all. But if you're really going for a fundraising or anything, better go with a company legal structure, private limited company formed and a startup, because otherwise it's just an idea stage, we can't be even called as a startup, right? So startup, if it is a recognized, you have to get DPIIT certification. Only if it's a recognized DPIIT, we can call it as startups. So get all that. Even if you go with the strong legal records and saying that this is a company is formed and you are a startup registered entity, then the investors will have say, okay, this is something which is credible, it is there, and it is just going as a founder, like, okay, I'm the founder, without a company name or without a company proper structure. They will not even the trust basis, the credibility issues will be there. So that is something which I suggest. And otherwise, but if you need any help at the early stage, so many incubations or anything, you can maybe try attending to that, but have a legal structure formed and do at the early stage itself.
Acha. I think your PPT was very well versed. So startups have also asking for the PPT, if you can share it
Yeah,
after the
yeah.
webinar with them.
Sure. Sure,
Uh,
sure, I can do that.
Definitely. Acha. We also have a question from within the incubation center. So we do get a lot of investor connects here.
Mhm.
But what are a few legal, financial, and compliance checkpoints that we must check before we suggest a company to a investor?
So investors also check that there are a lot of investors who have like with their segments will pay there, right? So that has to be checked if the investor proper, if they segmented. And investors again, whether it is an angel investors or if it is a VC backed investors, all that. So check that if they are also registered entities or if they are like angels. So based on the early stage startup, then angels will be fine. So we can align for the early stage. Or if there'll be pool of investors, right, where there is like a special purpose vehicle they have created and they're going for that. So in that case, if the initial thing and all that for the early stage, it can be done. For the pre-series or anything, if the investors are really good and going for a big round of series, then the VCs can be backed out. For them, again, check their which segments they are in, which they are interested in, and if their documents and what are their what they look into the companies. Like the early stage, they'll also have a certain criteria. Based on the criteria only, we can give the to the companies, like if they are really interested and if they match it or not, then we can do it. So investor credibility in that is also very important, because most of the investors, I have gone through a case where one of the investors, like so many people, like how you say the founders, there are a lot of investors without any credible things, if they give the fake promises and then they say without any signing an agreement in the beginning that they are the investor, and then they go up to the saying the founders to do that, do this and all, and later even they will get vanished. So there are a lot of, we need to check the investor credibility also. Like because see, it's when you're choosing an investor, it is not we're going to beg them, right? We are telling to become a part of our company, so that it's like we are growing and we will grow you also, they are also getting benefited. So always we make sure that in that point that we go to the investor who is ready to travel with us in a long way, who's really believe in us and who has the trust with us. So founders has to see this, and it is not that you're getting any service from them or you're not begging for the money. So see in that angle and choose your investor wisely.
Uh, Sheetal, thank you. I also have one question of my own here. When do we offer a board seat to an investor?
When we
When is
observe,
it a seat on the board to an investor? When is it advisable?
for the incubation centers kind of a thing you're asking
For
about,
a for
a
for a
company, right?
for a
Yeah.
company.
So yeah, that is another one about a question. It's like an advisory when you say. So not all the investors has to be bring into the advisory board. If you really think that it's one of so-called investor who can bring real value to your company, maybe he'll be in the same industry. If it's an e-commerce industry, has got good background in the e-commerce industry, or if it is in any other, whatever is your thing, he can bring either one way it is, then he can bring value to your company, to maybe connecting the customers, or he's related to it, he has got more referrals in that way, or he's ready to tape it, he has got good knowledge in this, and he can for the product tech development, if it's really good, and he can help you in the tech development in that way. So either in marketing or in a tech development or through a referrals, if you really think that if he comes into the board and he's ready to take up the decisions and he's ready to save time also for you and time and efforts. And most of the investors once get into the advisory board, they may not even have time. So that also we have to check that they spent at least a quality time, at least like whatever is the terms and conditions in the advisory, like in the initial agreement, maybe in 1 month, one time or 2 months, whatever it is agreed. And see, it is like you really end up having some value from that investor, only then you bring to the board. Otherwise keep them only as a shareholder of the company, don't bring it to the board, because that's always possible to have a shareholder. It's not that all the investors has to be on the board. So it's always separate, that directors are separate or advisors are separate of the company and shareholders are separate.
Thank you. Acha. So Vikram has asked, he got his company incorporated in 2021, but he has
Okay.
not started any business in the company. Will this impact in the future? Well, the company is not making any revenue ever since.
Investors point of view, of course it will matter, because it's been now 3 4 years more than that, and then investors will raise a question like, what have you done till now? If you can show some proof, like maybe you're building your product or you have made some other tractions and that's the reason, something like that, if you can show up, it's very good. But if it's from 2021 until now, if make sure that you have at least done the compliances which I've said, which is that annual compliances and other things. If not an yearly, it will end up in a lot big huge penalty. So even if you're not doing any business or anything, if you're taken GST, may do the GST filings properly and the annual filing compliances properly, if no other business also you're doing in the compliance point of view. Investor point of view, of course they will ask this question, so have a ready answer with you that what you have done till 2 3 years, why this taken time, maybe you have pivoted or maybe you have done it. In that case you can have.
Thank you. So Shubham has asked, so what are some exit strategy provisions that they can add to their founders agreements?
So one thing exit, maybe they wanted to be get acquired or no acquisition kind of a thing. It depends upon what product they're using, or maximum they can say like an IPO if they wanted to end up in an IPO, or if they're doing for any other collaborations, or if they wanted to go for any joint ventures. So depends upon what kind of a business they are, they can choose this exit option and they can mention it in the agreement.
I think just a clarification. I think they meant for the exit of one of the founders from the company.
Oh,
Who is
okay.
the
Exit
founder?
of the founders. Exit of the founders means that has to be like, if at all founders agreement is there, then there'll be vesting of shares. That founder will have a certain share with them. So if that clause is done, then no problem. If the founder want to exit, either he can transfer the share to the whoever it is, or the company can even buy back the shares. And then from the director board, he can even resign and go. So, but they should make sure that there are the two directors and two shareholders in the private limited company, which is a mandatory. So, before exit of another founder, try to bring in another one more director on board, and then make this director removed from the board.
Thank you. So Vinod has asked if we should deduct or deposit TDS at the time of exercising the employees' ESOPs.
So ESOP at the time of when you're going for it, at that time we have to check the provisions and what is the TDS properly applicable for that, whether that employee we are giving and all. So then we have to check, and for the individual only that will be mattering. For the company, normally when the TDS is not like the company's point of view, it is the share we are giving. The ownership is there. Employee it will get as a TDS. So that depends upon what is the amount and what is the time and when it is this thing, that the TDS we'll have to check and I have to tell you on that.
So that will be case to case basis.
Case to case basis, yeah. So when it is and all that.
Maria has asked, so can we raise investments, and do you have some references?
Raising investments, of course you can raise investments. So it depends upon what product you are and how it is like. So you should have that confidence in your product. So before raising, what one suggestion which I give is, before raising any investment, have it like you have some traction. You should have a confidence, right? Before you selling to an investor, have that confidence with you. Either early tractions is there, you have early tractions, or you know that there is customers willing to buy your product. At least if you have that clarity and confidence in your product, if you go to an investment and say that your financials and your compliances are properly done, and you can pitch to them, of course they will be ready to invest in your product. And I do have investor connections, so I will have to look into your pitch deck and how it is and all that. Then if it is really good, and I can send it to my connections, so happy to, we can send it to my mail ID.
Definitely. Another question from my side. We see a lot of people raising funds through these fund me websites for their new startups and new products that at the ideation stage. So is it just happens in the West, or is it, can we also do it here in India?
We can do it if it is properly legally, if it is done, and all the to raise the funds, if the legal all the thing is done, because we cannot raise or any deposits all that properly. It has to be maintained, right? The recordically, even if you are fundraising and all, not like individual, right? If you're forming a company, if that proper structure and maintenance is there, then we can do it. But again, it's case to case. You have to see like what kind of funding or where you want to do it, what is the amount you're looking for, and what type you want to do it. No, so all that, like unlike Western, there will be a lot of rules and regulations in here also, right? So that law and our law is not same. So even the safe notes and all for YC and all, it is done, but we cannot do the same here. So like that we have to check for the funding part, and then if that is in all okay, we can, if properly done, then we can go for it.
Okay. Aditya has asked, can we create category B ESOPs in India?
I'm not, I don't know, I've not dealt with a case like that, but maybe, I can check with that and I can get back to you if that is possible here.
Are there this is a question from my end. Are there different types of shares in India?
Yeah,
The
yeah. We have equity shares, we have preference shares mainly. These two
like,
shares will be done. So equity is mainly the ownership kind of thing. Preference share with the differential rights it will be there. So preferential, maybe the voting rights, depends upon what is the criteria which is given. Not all the voting rights will be there for the preference shareholders. But at the time of liquidation, or they can claim more fixed dividend, they can claim like only after giving the dividend to the preference shares, then the equity shares will get it. Shareholders they will get it, so they have a lot of preferential rights than the equity shareholders, but equity shareholders are the major owners of the company. They are.
so we have another question here. So when we are allocating shares to an advisor or a mentor, so should we give it to from the pool of the founders, or should we create new shares?
So, of course, we cannot give it from ESOP because that is especially for the employees. There'll be sweat equity kind of thing. So, it depends
Mhm.
upon the company that we'll have to check, because sweat equity is majorly given. It is a pool kept for the advisors or mentors and other things on the board. So, that can be given. Otherwise, from the founders, again, I have to check what is a company, what is the structure, if there is any pool created and all that. So, in that case, we can give from the founders too. Just a transfer, maybe.
Can we compare registrations of a company in India, or Dubai or UAE? Well, is it better to open an office in Dubai or UAE?
So we cannot compare that. It is totally different unless until if you have like your customers in Dubai, or if you have any joint ventures or any setup in Dubai where you really think that going to that place can give up more value to your company, and that is a place where if you register your company you can do more businesses, then it's worth going there. Same way for the US, Singapore, or anything. Just like that, you don't have to register there unless you have the customers or you have partners or anybody in that area to take up your business and run there, then only register it. If you think that only India is your business and you wanted to do it only here, then Indian it's fine. If you wanted to switch and if you wanted to go to any other place where you think there is a potential, of course it's good to register and go set up a business.
Are there any tax benefits as well linked
Yeah,
to?
there are a lot of tax benefits. Of course, it will be there in different places. It's different tax benefits that again, we can check, and that tax benefits is always there. Depends upon wherever it is. So, of course, comparing to India, a lot of tax benefits are there.
Okay. Is it mandatory for early stage companies to have an ISIN created for issuance of shares in?
If the Demat account, there are small shareholders not there, but if you're getting into Demat, then ISIN it's mandatory. So that again, if you have to check your company which comes under the small shareholding, or if it is a this thing, if
But
you that limit if you're crossed, then we have
Hmm.
to do that.
Okay. For startups, for creating maximum value, where should they focus on? Investors, incubators, or partners, or consumers, employees, or partners?
Maximum value in the sense value in terms of
Value in terms of uh,
money they're asking, or
for the investor,
valuation.
for the investors.
So the company is having a lot of value for the investors, if they have, where they should focus on. So if they have the value, again I'm confused, if they have the value like I don't know how they
I'll
are
repeat the
valuing their
question again. Okay.
company.
For a startup, should
Huh.
we focus on maximizing the value for shareholders, investors, shareholders, including investors, incubators, or partners, or the stakeholders, consumer, employees, and partners?
So of course, consumer employees, if you have more consumers, not I don't say like employees, you have to bring in more employees. Like what is
Hmm.
your limit based on your work? If you how many employees you need to your company, bring your employees and worth and file it. But in case of consumers, of course, that is the most important, right? You don't have to go to the investors if you have consumers ready to pay, and if you have business coming in, and then you can do it and the run your company, then you don't have to go to the investors and just like that bring any shareholders on board and all that. That is not necessary. But if you want any expansion, further expansion of the business, and you need more funds and you wanted to get it, at that time you can go to the investors, or you can raise the funds or accelerator programs, or whatever it is, you can raise it. Other than that, if you're self-sufficient with whatever you are current, if you're making a good set of revenues, then you don't have to go for any investments.
I think there are a lot of companies who are in pre-revenue stage right now, who are willing
Mm-hmm,
to, well, who wants to raise funds at this
mm-hmm,
stage. but they don't get enough traction from the investors as they do not have enough revenue. So what would be the best suitable mode of investment for them, and what are the few legal checklists that they must cover so that they get a good value on their investments?
So, legal, of course, whatever the current compliances and everything that they have to do it. So,
Hmm.
the fundraising thing, even if it is they don't have any business running, also legal compliances, whichever
Legal com
mandatory, they have to go through it.
Okay.
Now, if they are at the pre-revenue stage, going to the investors, most of the investors they look for the revenue. Okay, so even if you're on the pre-stage, revenue it is mandatory because they look into it. What is that revenue stage? You don't have to make a profit is a break, like after the break even you come to a profit, but there should be some revenue which you would have generated. Else if you're in the idea stage, your idea is too good that you have a IP done, and you know that this is going to the next stage, you can always bring it. At that time you can make tell to the investors that this is there, you have that confidence and you can show to them. If not, at least at minimum, like to the any customers, if you are in a early pilot stage and all, have any pilots, maybe like 30 or 50 users using your product, and they say that your product is really good and there is some viability is there, and that really helps them that to make it whatever it is, that if that traction, if they can show, if they don't have a revenue also, even that will be good for the investors, knowing that okay, this product is something which they are building it, and later that has got a scope and there are customers ready to buy your product. Even if that is there, then investors may even consider that, even if you don't have a revenue also, but there should be at least some kind of traction need not be that always it should be in a revenue stage. At the early stage, even you can show like some testimonials that people have used your product, or some pilots, whether they are using your app and they are feeling it really good, or if it is in an app or a website, you can even show them the downloads and there are people using it and they're trying it and you have talked to them. So all that can also be shown. So in that case, then investors will know that okay, there is something happening in this company, there's a good potential in it, and then they can go to the next stage. So that is worth showing it.
And is there a preferred mode of investment also
Preferred
for
mode,
these?
you can go for the angels. So in the initial stage, two things. First is that you can do the bootstrapping. Bootstrapping, if you don't have funds, you can go for the friends and family around
Yeah,
you, who are known
Sheetal,
circle.
sorry to interrupt you. I meant for
Yeah.
in the mode of investment, is it direct equity investment or
Oh,
CCPS?
no. See, so you don't have to go for a diluting of shares with the equity, but investors that we cannot say, unless the investor maybe he will not be ready for the CCD or CCPS, you may end up have to transfer the shares of the equity. Else, you can always ask for a CCD or CCPS. CCD is a good option, it's a kind of debt which will be converted into later, so they don't have to dilute the equity at the early stage, so they can move to that mode. And if it's, I said, if it's a registered entity, like if a DPIIT recognized startup, and if their check size up to 25 lakhs or more, they can choose as a convertible note as well.
Okay, thank you. I think we have Maria again. She is asking if you can share a list of basic documents needing that a startup must prepare before they go for fundraising.
Yeah, so I'll share the PPT. So in that it was there, the basic documents, what all has to be done.
So,
Uh, so it's like legal, financials, compliances, IP, HR, traction. So all these things, right from the legal company incorporation certificate to your previous balance sheets and everything that has to be done, which is mandatory, audited sheets, and all the filings. And if there is any IP, that IP, and whomever you're hiring, like any NDAs you've signed, or ISO policy agreements is there, or any other basic agreements which you have signed with any companies, that is also good to keep it in the due diligence process.
I think we are done with all the questions here. Shagun, do you have any questions?
Okay, so Hashitul, so what one book you would suggest to all the startups that they should read?
One book.
Yeah.
That it depends upon each thing, so I cannot say which book. To be frank, I don't read much books now, everything is blogs
Okay.
and things like that, so I am not the one who read a lot of books. I can suggest zero
Okay,
to
so
one,
for
so those kind of minimal
hmm,
books only I have read it, and I have a lot of my law books to read it, so too hard to get time.
okay, that's okay.
But
Okay,
you should
so
get updated. Okay, so whatever, maybe in whatever ways, like see, and don't have to always get any advice or any books and take pick copy of it. Whatever you feel is relevant for you for a startup or anything, because everybody's perspective and everything is different, right? So what you think is good for you, do that and get updated. There are a lot of events happening and there are other things, no? And talk to founders, talk to any other professionals, have a regular chat. Then itself you will get updated. I think that will be itself a pretty good to start with. Yeah, sorry I interrupted. So there was something else you were asking, no?
Hmm. Shagun, do you have any other questions?
No.
Uh, I think Sheetal, we have answered most of the questions here. Thank you so much for your time. I think just I would ask you to wrap it up if you have any final suggestions for our incubated startups. And we have, I think, startups beyond our incubation centers also have joined us here. If we can just, if you have the final some words for from your end.
Yeah. So, any like, if you are an aspiring entrepreneurs, who wanted to get in the startup world, all these like legal and compliances, whatever I have said, keep it in your mind. Other than that, what I said, the most important thing, validate your product. See that you are at the you're validating your product like properly, like done either in a research or you have tried your product and people are ready to use your product. Do the idea validation and then jump into a company. Just because if then you are in a wanted to start a company and you're in the early stage, you have a product, don't go for company registration and don't end up paying later a lot of huge penalty and all. Have some idea stage, it is done properly, maybe get incubated to any incubation centers or get into any accelerated thing and validate your product properly, talking to a lot of mentors or advisors and all that. Then go for a company registration. If you have already a registered entity and then you wanted to go again, this validation is very, very important. Maybe you would have validated, but the next stage, go to a customers, talk to a lot of customers. Maybe if you're a tech product, we'll be thinking a lot about a tech, like the features will be good and to add on more features. Instead of that, think in a customer perspective and see if this is really useful for them, whether they will buy your product, whether they are ready to pay the product and they buy it. So see that case. And legal and compliance side, don't forget it. However busy you are doing your tech and doing your investor readiness or whatever it is, even if you are just assign employees or assign an auditor or assign anybody for checking this, and have it always done in a proper checklist and maintain it. Spend the time at least 3 months once, check all the legal and compliances, all the documents are done. Otherwise you will end up paying a lot of penalty. To avoid that, do it at the early stage itself, all the legal and compliance is done properly.
Thank you, Sheetal.
Yeah.
That it was an insightful session. We have learned a lot here. Thank you
Thank
for
you.
answering all our questions here. For any more questions, startups, please feel free to contact her. Her email
Yeah,
ID
yeah.
is on the screen. And we have also tagged her on her LinkedIn profile on our LinkedIn post. You can check from there, and we will try to share the link, or try to share the PPT with you guys as soon as possible. Thank you once again, Sheetal. Thank you, Shagun.
Thank you.
Thank you all the startups for joining. Bye bye.